Why smart investors are skipping the bank and going straight to the seller. In today's high-interest rate environment, traditional financing has become one of the biggest barriers to real estate deals. Bank underwriting is tighter, rates are higher, and timelines are longer. But at VenusVenture.us, we've found a powerful workaround, and it's not new. It's seller financing, and it's making a comeback in a big way. If you're an accredited investor or operator looking to grow your portfolio without giving up control or overpaying in interest, here's why seller financing could be your best tool in today's market. Alright, so let's talk about seller financing and why it's such a powerful tool in real estate. Basically, it's a way to buy property without needing to go through a traditional bank or lender. Instead, you work directly with the seller to come up with terms that work for both of you. What is seller financing? Well, seller financing, sometimes called owner financing, is when the seller of the property actually acts as the lender. Instead of going through a bank, you negotiate terms directly with the seller, who agrees to accept a down payment, finance the balance over a set period, usually somewhere between 3 and 7 years, and receive monthly payments with interest, just like a bank would. So here's how it works. The buyer takes possession of the property, while the seller keeps a lien on it. Pretty much the same way a mortgage works. Seller financing, is becoming more and more attractive in today's real estate market. It gives both buyers and sellers a lot more flexibility and can really open up opportunities that just aren't possible with traditional bank loans. In this environment where lending standards are tightening and interest rates are high, seller financing can be a real game changer. Why does seller financing work so well right now? Well, high interest rates have made traditional loans expensive. Like, we're talking rates above 7 or even 8% on commercial loans. That kind of monthly debt service can just crush your cash flow. But with seller-financed deals, you often get lower rates, or sometimes even interest-only payments for the first few years, which can make a huge difference. Another big thing is that banks are saying no more often. They're tightening up their underwriting standards, asking for higher credit scores, more cash reserves, and lower loan-to-value ratios. Seller financing just cuts the bank out of the equation entirely, which really speeds up the deal and makes the whole process a lot smoother. So, sellers are more flexible in a softening market. In a slower market, some sellers are actually willing to offer financing just to secure a buyer and, achieve their desired price. In return, buyers can get better terms with less upfront capital. At VenusVenture.us, our strategy with seller financing is all about creating opportunities that benefit both the buyer and the seller. We look for properties where the seller is open to flexible terms, and then structure deals that minimize our initial investment while still meeting the seller's needs. This approach lets us move quickly and adapt to changing market conditions. Here's how we use seller financing at VenusVenture.us. As a new and agile firm, we focus on building long-term equity in properties with upside. And seller financing really allows us to, first, preserve capital by reducing down payments. We can also structure creative, win-win deals that align with the seller's goals. Plus, we increase our cash-on-cash returns by minimizing expensive debt, and we're able to move faster than traditional buyers who are stuck waiting on lender approval. In several cases, we've offered sellers full asking price, or close to it, in exchange for terms like 3 to 5% interest, no bank underwriting, and flexible balloon payments in 3 to 5 years. Alright, let's dive into a real-world example of seller financing success. This is where things get really interesting, as we see these strategies come to life. Real example: turning a no into a win. We recently targeted a mixed-use building in a growing secondary market. Traditional lenders wouldn't fund it due to vacancy and low current NOI, but the seller was tired of managing tenants and motivated to exit. So, here's what we proposed. 20% down, 4% interest-only payments for 2 years, and then a balloon payment at year 3. Plus, we made a full-price offer. No bank delays at all. The seller said yes. Now we control a high-potential asset, and honestly, we've got time to reposition and improve the NOI before we even need to think about refinancing. If you're thinking about structuring a seller financing deal, here are a few tips. First, always be clear and upfront about your terms. Make sure you understand what the seller needs, and try to find common ground. Don't be afraid to ask for flexibility on things like interest rates or payment schedules. And, having a solid plan for improving the property can really help get the seller on board. Just remember, every deal is unique, so stay creative and keep the conversation open. So, if you're pursuing this strategy, here are a few tips to keep in mind. First, be transparent. Sellers are way more open when they trust your vision. Next, offer trade-offs. If you want better terms, maybe offer a higher price. Always put everything in writing. Work with a real estate attorney for sure. And know your exit. Have a clear plan to refinance or sell before the balloon payment is due. Final thoughts here. Seller financing is really a win-win tool. In a tight credit market, it allows buyers and sellers to meet in the middle. It's flexible, fast, and cost-effective, making it possible to structure deals that still work, even when rates are high and lenders are, pretty cautious. Just to sum it up again, seller financing is a win-win tool. When credit markets are tight, it gives buyers and sellers a way to meet in the middle. It's flexible, fast, and cost-effective, so you can still make deals happen even when rates are high and lenders are a bit wary. At venusventure.us, we're actively using seller financing as part of our strategy to acquire undervalued assets and grow our portfolio in this new market cycle.